Ho, 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 Biconomy friends. Welcome to Highlights. Last week brought a powerful mix of cooling inflation data, regulatory shifts in Washington, institutional tokenization moves, and new long-term Bitcoin forecasts from major banks. From the Federal Reserve stepping back on crypto restrictions, to U.S. Treasuries being tokenized, and lawmakers pushing fresh crypto legislation, the market saw meaningful developments that could shape how crypto starts 2026. Before we jump into the headlines, let's take a quick look at prices. Bitcoin traded mostly in the $84,500 to $91,000 range, pulling back early in the week before stabilizing after softer U.S. inflation data. Ethereum just reclaimed $3,000, fueled by scaling upgrades next January. Solana cooled to $117 and is now back to $128, while XRP stayed between $1.80 and $1.95. Supported by continued institutional momentum. SUI remained between $1.32 and $1.48. Stellar's XLM traded near 22 cents of a dollar, and Zcash stood out with a quick dip to $375 and an even quicker recovery to $450, holding gains as privacy-focused assets continue to attract selective demand. Overall, this was a week of consolidation, not panic, as markets digested macro and regulatory signals. One of the most important catalysts last week came from macro data. The latest U.S. CPI report showed inflation at its lowest level since 2021, reinforcing the narrative that price pressures are easing. Bitcoin reacted by sweeping liquidity to the downside before rebounding, a classic move in low liquidity environments as traders reposition ahead of potential rate cuts. At the same time, Bitcoin's weekly RSI dropped to its most oversold level since BTC traded near $15,000 during the last bear market. Historically, readings like this have preceded medium to long-term recoveries. Not a guarantee, but a signal that selling pressure may be getting exhausted. Adding a longer-term institutional lens, Citigroup published a new base case forecast calling for Bitcoin to reach $143,000, improving liquidity conditions, expanding institutional access, and growing use cases beyond speculation. Coming from a global bank of Citi's scale, this reinforces the idea that BTC is increasingly being modeled as a macro asset, not just a tech trade. On the regulatory front, we saw several constructive developments in the U.S. First, the Federal Reserve officially withdrew previous crypto-specific guidance for banks, removing restrictions that had discouraged financial institutions from experimenting with digital asset services. This opens the door for banks to engage more freely in custody, settlement, and blockchain-based innovation under existing risk frameworks. In parallel, the U.S. Senate confirmed new crypto-friendly leadership at both the CFTC and the FDIC, indicating a regulatory shift toward clearer rules rather than outright resistance. This change in tone matters. Leadership sets enforcement priorities, and markets are paying attention. Adding to that momentum, the White House confirmed that David Sachs will push the Crypto Clarity Act to the Senate in January, aiming to define regulatory responsibilities across agencies and reduce uncertainty for builders and investors alike. On the infrastructure side, one of the most important announcements of the week came from DTCC, the backbone of U.S. financial market settlement. DTCC confirmed plans to tokenize U.S. Treasuries on the Canton blockchain, a permission network designed for institutional finance. This isn't a pilot on a fringe. It's a core piece of Wall Street infrastructure experimenting on blockchain rails. In Europe, the stablecoin story continues to grow. Euro-denominated stablecoins surpassed 1 billion euros in circulation, with Circle's EURC leading adoption. This is a strong signal that demand for regulated non-USD digital currencies is expanding, especially for cross-border payments and on-chain settlement. So last week in summary showed us, inflation is cooling, Bitcoin is technically oversold, major banks are publishing six-figure BTC targets, regulators are stepping back, not tightening, treasury bills are being tokenized, and stablecoins are growing beyond the dollar. That combination keeps me optimistic going into 2026. Thanks for watching. Don't forget to like and subscribe. I'll see you next week as we head into the final stretch of the year.